Everybody, this is Stephanie Dorsey, CEO and co-founder of Margins Capital. I'm excited for week 2 of the meet and greet with Margins, and we're meeting and greeting Erin Harkless Moore, who is the head of investments at Pivotal Ventures. She's going to talk about all the wonderful work she's doing and how they do this wonderful work and why they do this wonderful work. So I did notice, I want to call out the elephant in the room, that as I was editing, I noticed that I had forgotten to turn my camera on. But, you know, the show goes on. Erin is still a G, and she is still a force and a voice that is worth hearing. And so ignore the fact that I forgot to turn my camera on and pay attention to Erin in this video. Thanks. So, hi, Erin. How are you?
Hi, good, Stephanie. How are you?
Good. I am so happy to see you and happy to be talking to you. And yeah, let's just hop on in if you don't mind.
Yeah, sure. Let's do it.
All right. So, can you start off by just introducing yourself and telling us who you are and how you got to be the Erin Harkless Moore?
Yes, happy to. So again, hi, I'm Erin Harkless Moore. Nice to be here today and chatting with you, Stephanie. So I am a native Texan. I grew up in San Antonio, Texas, and have, from there spent kind of most of my adult professional life on the East Coast, New York, Boston, and then I now call Washington, DC home. But I wear, many hats. I'd say mother, daughter, Texan, DC transplant / Washingtonian investor is my day job. And I started my career on Wall Street, and back then there was a much kind of clearer, bright line, even I'd say, between kind of the traditional finance and kind of social impact work. And the latter was really more what I did in my spare time. And I didn't see kind of how to bring both together, but I I majored in finance. I also had a second major in English literature in college. So I always kind of had this dueling, like, left brain, right brain fight going on, and loved the financial rigor, the analysis that I was doing in my work, but wanted to find, more ways to kind of bring together the diversity, equity, inclusion, just other pieces of how I was showing up in my personal values into my work. So when I went to business school and get my MBA, I was kind of immersed in an environment. That was a great time for reflection at that phase of life and career, to think, much more carefully about how I wanted to spend my time, because we spend so much time working, and I wanted it to have meaning and value. So I was sort of seeing the rise of ESG, impact investing, and sort of saw this kind of harmonization of how to bring that together, with the work I was doing, which has largely been, sourcing and doing diligence investing in fund managers across asset classes, but a heavy exposure and emphasis in the private markets is where I've spent much of my time. So I've been thrilled, kind of professionally, for the last decade, to have found that greater alignment in investing with my values and my purpose, sort of doing those in tandem. And that led me to Cambridge Associates in many aspects, where I was for a little over 8 years. And then I joined Pivotal Ventures about a little over 3 years ago, to lead the investment team there, having social progress and change, but doing it, with a market first lens in our investment strategy. So that's kind of the day job. But like I said, for fun, I spend a not insignificant amount of time chasing after my 2 children. I love to eat, so you can find me in DC checking out restaurants. Not cook. I like to cook too, but I like to go out to eat, and reading and writing and all those things are other passions and ways I spend kind of my limited downtime. That's me.
Exactly. You can't change the world and have a whole bunch of free time at the same time. It rarely aligns that way. I did have a question about when you thinking back, and you think about when you were a younger person and you're like, gosh, how do I have the social impact that I want, but also do finance, which I love. Was there
and people talk about the E, the S, and the G, but was there a
Yeah.
particular bucket or lane in impact investing that really drew on your heart, on your desires?
Oh, it's a great question. I'd say more of the S, the
Okay.
social side, equity broadly, social equity, gender equity, racial equity. I'd say all of those, and that intersectionality and interplay between all of those levers was the side that always kind of jumped to me most. Although I will say too, if we don't solve our environmental problems and the climate crisis, then we won't have a place to operate from at all, and an
Yes.
earth to call home. So I don't
Yes.
want to understate the importance of that, but and then I've done that work and invested, also with that lens. But the primary focus was always more, for me at least, on the and my passion was more on the S side.
Okay.
And G too, I would say, you can't, nothing you do if you don't have the foundations of good governance, corporate governance, governance in your investment committee, your board, what have you, then you're not going to have success. You could have the best access to investments, the best ideas, but if you don't have the conditions to good decision making, it'll all fall apart.
Oh, I want to dig into this. So, like, the G part of the ESG sounds like table stakes. Why
Yeah.
is it in this newly packaged ESG? Like, why is it in this newly packaged thing that everyone is
Yeah.
talking about when weren't we investing that way for the last, 25 years anyway?
Yeah, I think, Stephanie, you're hitting on an important point here in that, yes, I mean, I think as investors, and I often think of ESG as a risk management framework, frankly, right? Like if you're
Okay.
not looking at these risks across the board, you're not doing your job as an investor, right? Thinking
Right.
about both the risk and the opportunities. They're both sides of those can play out. So I think, again, good and investors were always asking, should have been always asking questions about governance. And I think it just kind of came together under that acronym because it was a thing that sort of made sense to tie together. But like you said, a lot of this work has been happening for a really long time. Just now with a maybe slightly more digestible label to
Yeah.
put it under.
We all love a good marketing
Yeah, we love a good acronym.
pithy. Yeah, like exactly. We love that. All right,
Yeah.
last question on ESG.
Yeah.
And this is, I think, will be useful for everybody to hear. Why has ESG, which we just talked about, makes so
Yeah.
much sense? Why is it
Yeah.
getting a bad rap in today? Like, what is
Yeah.
going on?
Yeah.
And a follow up on that, the second parter is like, why are we only in the ESG? People only highlight the racial equity part of it and use that to um, throw off the entirety
Yeah.
of what ESG is about.
Yeah. Yeah. I mean, I think it's anytime you're disrupting perhaps the status quo, it makes it easy to throw a harsh light on something, and I think that's kind of
That's what it is.
the probably the punchline. That's what it is because, again, if I had this experience when I was at Cambridge Associates, a fund manager in the public markets, that was looking at, different factors, including, environmental, social governance, framework to evaluate companies. If you were to just, with one client I served, we took out kind of mentions of ESG because it led to some consternation among the board for a variety of different reasons.
Mhm.
But they all said, "Oh, this is great. What a great way that they're assessing these companies." And I'm sitting back here thinking to myself, this is but you take the label out and people see and kind of appreciate the fundamentals of what you're doing. So I think it's just become the latest thing to kind of attack,
Yeah,
despite, and for, with good and bad intentions, right? Like some
yeah,
people greenwashing, slap labels on something, aren't actually doing
yeah,
that work. So you have to bring a critical eye to everything,
yeah.
regardless of, if you're doing diligence on something, bring a critical eye, a skeptical eye, and don't take it at face value. And I think some of that has, afflicted the kind of, ESG and impact spaces as well, over the last few years as well.
Tell me about your current work and Pivotal, and specifically what are you doing there today?
Sure. So At Pivotal Ventures, we're on a mission to bring more opportunity and equality to people here in the United States. And for us, gender is a big piece of that. And for us, that means getting more women in the positions to make decisions, control resources, shape policy perspective, have access to capital to drive, again, the decisions that they want to make in their homes, in their workplaces, and in their communities. So that leads to the work that I do as a part of our investment team, leading our investment team at Pivotal Ventures. We're trying to change the game and how capital is allocated. Who has seats at those tables, who has access to capital, and again, controlling those very important and precious resources. So we invest in fund managers that all private markets, venture capital has been our focus primarily to date, but women-owned and led funds that are investing across a variety of different themes and sectors, but all based here in the United States. And there's really a sort of two-part theory of change to that, of our thesis of one, as more women are controlling and owning these firms, they'll build wealth, right, for themselves. And then also with a more diverse, hopefully, set of decision makers, we'll have more diverse founders get funded as well. Even if diversity isn't the stated mandate, right, or selection criteria, the data has proven out, more diverse teams make better decisions, back, other diverse folks and bring more people in. And the sad fact is, only 16% of check writers, decision makers at U.S. venture capital firms are women. 2% of funding, early stage funding, goes to female-only founder teams. So there's huge imbalances and opportunities, and we want to show you can make a lot of money, again, with that thesis and getting capital in the hands of women. We also do some direct investing that's aligned back to programmatic focus areas. So for us right now, a big area of focus is in the care economy, solutions that improve access to care, reduce burdens and costs of care, that are, again, impacting up families, women, all caregivers. I say we're all caregivers at some point in our lives. And so we're looking to invest in the next generation of founders and companies that are also building in that space.
Oh, I want to dig into the care economy piece. Is that like across caring across all ages, or are you only focusing on elder care or
across all stages? So for us, we think of it, that childcare, parenting, all the way through to the kind of elder care, aging, longevity, and in that, solutions that are kind of acute caregiving needs. So think mental health for youth and families, women's health as well, maternity, postpartum, menopause. I mean, all of these stages that are frankly kind of overlooked and underinvested. We see huge opportunity to, again, innovate and bring that market lens and drive more capital to, again, provide hopefully better outcomes for all of us, all Americans.
Yeah, as a person who's sitting in that sandwich generation, I am over the moon excited to see that you all are investing in that space, and I can attest that innovation is absolutely necessary.
Oh, well, good. Well, we're hoping to keep shining a light. The care economy is a $648 billion market. Easy. I like to share that stat because when I first heard it, I was like, wait, what? It's bigger than the pharmaceutical industry, that whole spectrum that we're talking about, but massively kind of still overlooked. And I think more and more investors are seeing the opportunity. There are plenty of companies that are, have started to scale and attract significant, investment and growth. And so we're excited about what's ahead because, again, these solutions, like you said, Stephanie, look, we're all dealing with it, right? Whether you're a parent, caring for a parent, a relative, someone in your community. I mean, it hits us all.
Absolutely. Awesome. Awesome. So now let's pivot a little bit and talk about, do you invest in alternatives?
Yeah, me personally, yes.
Yeah. Yes, you, okay.
Yes, for Erin, not just my day job. I've done a little bit, some through vehicles or access to things I've had, throughout my career, or other platforms, and what have you. I also, though, to be candid too, like in my personal portfolio, I try to keep it relatively simple. So mostly, public equities, and the markets there, because I think, over a long time horizon, that's the simplest and most efficient way to kind of compound wealth.
Yep.
But at the same time, if you can have access to the deal flow, I think the alternative space, again, early stage venture, real estate, all of these are areas that can also help in compounding your wealth. I think for myself personally and my family, it's just assessing our risk tolerance and time horizon, and I think we have the ability to take on some of that risk, and also the network, where friends may have started companies, or I've attended some events with like angel groups and other stuff. So you're kind of in the flow to find the deals. I think that's half of it. If you can do that, then alts makes sense, and that's kind of the lens that I've brought to my personal portfolio.
I love it. Do you mind sharing specifically what asset classes you're investing in?
Yeah. So again, I've looked, and largely, again, it's a lot. We haven't not done quite as much in direct, kind of directly. Have looked at some funds where we've had opportunity, again, through friends or other things in our network. So that sort of, again, falls more in the kind of venture side of things. And I always, my not to call him out, my brother is does real estate development, and so I've often chatted with him about if there are things that he's doing, something that as a family we can support. So that's also on my radar, although haven't directly done anything there yet.
I ask because, so do you have a point of view about, and I hate to use this term, but I'm gonna use this term and I'm gonna qualify it, like retail investors, but the emphasis on investors. So people who have, a little bit of savvy or sophistication to them, not just anybody. But do you have a point of view about sophisticated retail investors investing in alternatives?
Yeah, it's a great question. I mean, I think, look, it comes back to me, about some of that access, right? And are you really getting the best deal flow and opportunities? Because you also are paying, as someone said to me once, and it's all sort of co-opt this line. The only thing that's certain in investing are the fees, which are the costs to do this stuff. Performance is not guaranteed. The fees are, you're going to pay those fees regardless, right?
That is right.
And so I think for, again, even sophisticated retail investors, for me, it's like, do I think I can have the access, the network, and ability to assess the quality of the investment opportunity to make it worth that cost, right? Because otherwise, you can, again, like I said, keep it relatively simple, and just, index or do, I'm a believer in active management. So, on the public side, public equity side, I have active managers in the portfolio, but I think you have to believe that they can outperform. And so that's part of it as well. And sort of that calculus and trade-off. And I think you have the right advisors too. I mean, I've benefited, from other financial advisors, that we've had as a family, some friends that do that work that I can call up or that might share opportunities with us, and having that trust in them that, again, their process is sound and robust, to know that, okay, I'm getting this deal through this advisor and I've vetted them to know that their quality, their track record is good. So all those things to me, I think, need to be true before, even the most sophisticated. I even say this for like anybody, like you could be a ultra high net worth person, the bar to do alts is high. And so I think those conditions need to be true for everyone to take that leap.
Do you have any advice in terms of, I mean, you talked a little bit about, making sure the person, you vet the person, you think a little bit about the track record, but I'm going to ask if you have any advice about risk management, due diligence, more specific takeaways that a person who's listening to this can implement in their own portfolio management process.
Sure. I think all those things I said, and for me, the team or the people, we're all in the business of people in some way, shape, or form, right? And so if you can, and in my day job, I think this is true for personal investing too, right? Like doing a few references, like kind of checking to make sure what you're hearing is true. And in this day and age, like odds are I'm never not surprised. You know, you go on LinkedIn, and you're like, oh, I know somebody that knows, or this is a real estate deal and X. Oh, my friend like lives in that neighborhood. Just some basic stuff. Like, let me call somebody up and like try and get a little bit, layer deeper in what's going on in that, as it relates to that strategy.
Yeah.
So that's one thing I point to. The second thing too is just, the strategy and ability to add value, in and of itself, but also I think about it in the context of just your portfolio, right? If you have every investment needs to stand on its own, but it's also complementing the broader pie of what pieces of is a pie of what you put together.
That's right.
And so that's one other piece of, are you throwing in that kind of knowing what you own and going a layer sort of deeper. Oh, I'm in this venture fund. Well, what are the underlying companies?
Yeah.
Do I have, if I invest in this next fund, am I going to suddenly be very concentrated in one asset and I didn't realize it, right? So it's just peeling back that onion, and I think having a very high bar for what is coming in is helpful as a risk management tool too. And just I always say, know what you own. Don't take really anything for face value. I'm probably sounding like a very skeptical, non-trusting person. But I think that's important when you're investing. Like,
exactly,
you should come with questions and sort of push, and you still won't get everything answered, right? And you're kind of constantly always doing diligence, but having that mindset, I think, is important before you jump into any new investment.
That makes sense. You mentioned your risk tolerance.
Yeah.
Can you talk about a little bit about, I guess this is the last question, what your risk tolerance is and how that impacts, the type of investments that you even consider?
Yeah, no, it's a great question. I mean, I like to think, and this is something I've learned from my day job as well, is there's the stated risk tolerance, and then there's like the risk tolerance actually in your belly. And I always go back to, in these crisis moments, and I do this with clients I serve when I was at Cambridge Associates and other places, where on paper, and this is true for myself as well, right? Like the same analysis. You say, oh, I can handle a big drawdown, or I've got a long-term time horizon, like I can ride the waves. And then you actually do the math kind of behind that and apply, say, like a 2008 financial crisis metrics, and you see where your assets would have gone.
Yeah.
Can you live with opening up your portal, but whatever it is, your bank account, and seeing 40% less?
Yeah.
If not, you may not need. Are you okay if you invest in this company? Probability is very high, again, in early stage and venture. Power, like 99% of this stuff won't work. So right. Are you okay with, if you have 5 investments, all 5 might fail for sure? Probably 4 will not work, and maybe 1 will be a big success, right? So it's like unpacking that piece, I think, is really important at getting at, like, do you have the risk tolerance? So for me personally, and maybe it's because I also do this as my day job, I'm not one to like I follow and track the markets and like know what's going on, but I don't allow myself to get into the like, let me open up my brokerage account and my 401k every month. And like, because over the last, year, I mean, the markets have kind of been going like this on the public side, but like, you could have those moments where it's down so much, I got to sell, or because that's the exact wrong time.
Yes. Oh my goodness.
And so that's where, in some ways, alternatives and privates are good, because you are locked up. It's a liquid, so you can't.
You just gotta hope and a prayer, like
you
for that.
Gotta hope and
5
pray.
years.
It's gonna turn, for 5 or 10 years. But I think that's part of it, and it's candid, and with your family too. Whether you're an individual investing with your spouse, your partner, family member, like make sure, because I may be able to ride the waves, but if my husband can't, then that's a problem. If he's going to be wanting to sell something when I think we should hold it. So having the frameworks, the ability to have those conversations, I think is incredibly important to kind of getting at assessing what your risk tolerance is. And I think it's probably true for most people, and I'd say this for myself. it's not as high as I like to think it is.
Absolutely. Absolutely.
Yeah.
Absolutely. And I have thoughts about that, but I know we're at time, and
Yes, well, to be continued.
Yes. Yes. Oh my gosh, Erin, it was an absolute pleasure chatting with you and learning
you,
from you
Stephanie.
today. And
This was so fun.
have a wonderful, wonderful day.
You too. Thanks so much. Talk